Hi, my name is Roy Rumbo. I'm an accounting professor at the University of North Texas. I teach Intermediate Accounting 1 and 2. And today's lecture is for my Intermediate Accounting 2 students, Accounting 3120 at UNT. I do use the McGraw-Hill textbook, Spiceland, Nelson, and Thomas, great textbook. Definitely highly recommend that. So with that, I'm going to get started. We're going to have some fun today. We're going to work bonds, payable, and installment note problems. So again, please stop the screen and work each one of these. Stop the video, work these, and then you come back and see me work at this. There's no better way to learn it than to do it. Until you're doing your own math and figuring this out. It's a little bit in the weeds, first of all, to get it done. Once you figured out how to do it, then I want you to step out of the weeds and try to understand the meaning of this. So let's have some fun. Okay, first of all, for my students, I always have for most chapters, a summary sheet that kind of helps you with an overview. So I'm sharing that here on screen right now. And so this is for bonds payable, not for installment note. And I provide this to my students via Canvas. But so here's some terms. And we talked about this in the lecture for this chapter, which was 14A. Now we're in the lecture 14B. So the face value, that's the amount of cash that will paid on the last day of the bond. Also called the maturity date. There's just a lot of terms here. So, I would say get over it. You're gonna have to deal with it like all of us do. And as business people, you might be one of those operational guys, finance guy trying to sell some bonds someday. So you want to understand these terms. So the face value of the bond, that amount we're going to pay the last day of the bond, the company's going to pay. It's also called the par value. It's also called the principal. It's also called the stated amount. Also called the maturity value. Exactly the same thing. Exactly. No difference. No difference. They're used interchangeably. I use them interchangeably. And then the coupon rate, which I usually like to refer to it as the coupon rate. By the way, it's also called the stated rate, the contract rate, or the nominal rate. So it has different terms too. But it is nothing more than determines the amount of interest that will be paid. By the way, paid is going to be different than earned because the investor is going to earn the market rate, and they will make sure they do. And that will be the difference between this paid rate and the market rate. That's going to be inside the price of the bond. The price of the bond will be different than the face value of the bond. If we pay a higher interest rate than the market rate here in the coupon rate, then the price of the bond will be higher than the face value. If we pay lower than the market rate, then the price of the bond will be lower than the face value. Just common sense. Think about it if you were going to invest in that company. The term is the number of years the bond will be outstanding. And then we're also going to have to get into the payments per year. So most corporate bonds and U.S. Treasuries are interest payments are made twice a year. What is paid? The coupon rate is paid, the amount stated in the bond. And so mostly it's 2 payments per year, semi-annual. And all the examples I work will be semi-annual because that's what you see with U.S. Treasuries and most corporate bonds. The yield, which is also called the market interest rate or the effective interest rate, that is I would say that's the real interest rate. That is after we calculate the market price of that bond based on the payments and the maturity value in the term, using time value of money, that bond is going to earn the market rate. That's why we use the word it's going to yield. And that yield was going to be different than the coupon rate. Market rates determine, it changes daily, just like a stock price. And it's based on the overall, maybe macroeconomic risk could determine the market rate, but also the company risk. More risky companies with volatile cash flows, maybe poor business models, up and down years, they are going to demand, market rate is going to be a much higher interest rate than a very successful, stable company. So that is where the market rate comes from. So again, second part of my little, I do call this a cheat sheet for my class, but they're not allowed to bring it in as a cheat sheet for the exam. But be good to memorize. So the journal entry for issuing bond, we're just going to debit cash and credit the bond payable account. And that bond payable account will always reflect the face value of the bond. Now, we will also have to debit a bond discount if the cash received is less than the face value, or credit a bond premium account. Now, how do we determine how much cash will be received? It's going to be the present value, and this just makes sense, I hope, to you. There's two cash flow streams, if you will. The face value that will be paid at the very end of the bond, that last date, we're going to have to find the present value of that. And there's also going to be an annuity and, semi-annual payments based on the coupon rate. And we're going to have to figure out the present value of that. And, that is based on the interest rate that is the market rate, or the yield, or the effective rate. And N equals the terms in years times the number of payments per year. I think this all should make sense for you. And so we also have journal entries here, and we'll see that as I work through these problems. So with that, and I made it a little easier for myself today, that I have a little template. And for my students, this template is available for you on Canvas if you want to print these out and work it. So with that, I'm going to, let me get rid of my little floating meeting controls panel here. So I would strongly suggest that you pause your video and go try to complete this. Number one, got to calculate the price of the bond. That's going to be the cash that's going to be paid. And will it be a bond premium or a bond discount? I would say do discounts as negatives and premiums as positive to reflect the difference there. So calculate that price. And then 2, finish this sheet out. And 3, do the journal entries. Usually I will require almost exactly for my exams, the journal entry for the issue date, journal entry for the first interest payment, and then what's the interest expense for the year. I'll at least ask those 2 things, but I'll most likely require my students to finish an amortization table. So I will pause here, let you pause, go work the problem, and then come back. All right. So first of all, let's see what we've got here. We've got a face value or principal or par value, 500,000. The term is 3 years, 2 times per year payment. Coupon rate, the stated rate is 12%. And the effective yield is 10%. Now remember, we're going to go calculate our present value, but N is going to equal 3 times 2, 6, and I is going to be 10% divided by 2, 5%. Because it's compounded twice per year. All right. So we get 2 present values. We get the present value of this 500,000, present value of 500,000 in 3 years, compounded annually. N equals 6, I equals 10%, divided by 2 equals 5%. And now we could just go do our math. Now you're welcome to use the tables. I'm going to avoid that today. As you know, I'm a big fan of my calculator. I just got to make sure I have it in the right mode. In mode, because these payments are made at the end of the period. So I've got to make sure I got that right. And so this is pretty easy. The present value of 500,000 put it up here so you guys can see this. That's more clear today than normal. Present value, N equals 6. Interest rate equals 5. And 0, no payments for this one. We'll do payments in a minute. So what's the present value? Oh, I screwed up somewhere. Let's try this again. 500,000 is future value. There's where I screwed up. And N equals 6. Interest rate equals 5. Payment equals 0. I think that's already set there. And so it's equal to 373. 108. I'll just go ahead and round that. So now that's one cash outflow stream for the company, 500,000 into the 3 years. They also have an annuity stream they've got to pay, and it's an ordinary annuity because it's at the end of the period. And so that's going to be payments of, and the payments are equals 500,000 times the coupon rate is 12% divided by 2, or that's going to be 6%. I think I can almost do that right off the bat here. 500. I'll make sure I don't screw up here. 30,000. And then N equals 6. I equals 5%. No change. N and N and I are the same as for the previous. Now clear everything out. Make sure I'm in the N mode, which I am. And so payments are $30,000 payment. N equals to 6. I equals 5. And then what's the present value? 152. To 71. So one way of thinking about this, the value to the investor, by the way, the investor is going to earn the market rate. How are they going to do that? Not if they pay 500,000 for 500,000, they got to pay less because the interest being paid along the way is on the only 10%. So got to true that up. So how much are they going to pay? We just calculated out 373 plus the 152. 25. $378. And so, oh, by the way, I totally misspoke here. That's dumb old me. They're paying more. The coupon rate is 12%. The market rate is only paying 10%. Because I kept saying it's a discount. No, they're going to receive more because they are paying more interest along the way. Now that 25,000, they're receiving more cash up front, but they got to pay more cash than the market rate going out. They're paying 30,000. They really only needed to pay 25,000. So they're paying a $5,000 premium every single period. So let's go do our math. So I'll do the first journal entry so we can get started. And that was on 1/1/18. We're going to debit cash. The company's going to sell this bond for $525,378. And they're going to credit the bond payable, not for that amount, but for the face value. We always put in the bond payable account the face value. And so we have a bond premium. A premium is always a credit balance. $25,378. So let's get started on January 1. What were the balances in this account? We had 500,000 in the bonds payable account. We had 25,378 in the bond premium account. And so the carrying value of the bond is the bond payable plus the premium. 525,378. Okay, let's go calculate the interest expense for the first 6 months. Yeah, and the interest, we know the interest payment, that's going to be, we already know that, 6% of the 500,000. So the payment of interest is always based on the coupon rate times the face value. In this case, coupon rate divided by 2, because they're paying that twice a year. The interest payment is going to be $30,000. The interest expense is going to be the market rate times the carrying value. Now that market rate is 10%, again, divide by 2. So you're going to have to do 5%. So 525,378 is 26,269. Now notice the payment amount was greater than the interest expense. That should make a lot of sense here, because we're paying more than the market rate. So we're going to, our first entry, we're only going to debit interest expense for 26,000. Let's just go do that entry. June 30, debit interest expense for 26. That's what we just calculated, 269. Credit cash for 30,000. And so we have more credits and debits. We need another debit. Where does the debit come from? It's the amortization of this account. We're going to reduce that bond premium account for the difference. So 30,000 minus 26,269, 3,731. If we looked at the T account for the bond premium account, we started with 25,378 from that very first entry. That's what we said. And now we're reducing it, 3,731. And so the new balance is going to be 25,378, 21,647. See how this works? And so this bond premium account, we're going to keep amortizing. I mean, we're going to reduce it down to 0. And the fact that this is another debit here, it has reduced our interest expense, if you will. Our interest expense is not 30,000, it's 30,000 minus the amortization of the bond premium. So the interest expense is less than the amount we're paying. Another way, and I know I'm trying to repeat myself here a million times, I guess, another way of thinking about it is that 25,000 right there. We received cash of 525, and at the end of 3 years, we only paid 500,000 now. And so we received more cash. That 25,000 is receiving, interest up front, kind of, because we're going to pay more out. And so we are getting to from a 12% to a 10% market rate. The investor, they had to pay out 525, and they only get 500 at the end, but they're going to get higher payments along the way. So it all trues up to be mathematically equal to a 10% yield. We're all good, regardless of how the payment stream works. Again, you're going to have to know how to do this table. So $30,000 payment minus the interest expense, that's the 3,731. Reduce this balance down to 21,647. My bonds payable, we don't touch this account, still sitting at 500,000. And so now on that, my carrying value is my bonds payable account plus my bond premium account, 521,647. Now we're going to do this, it's going to be boring for you probably. We're going to do this 6 more times. And every time, I'm going to go ahead and put these in. Every time we're going to have the same payment of interest. There'll be 6 of these. And we have to go calculate interest expense. So 26,269 times 5%. That's not right. No, I'm sorry, 521,647 times 5% is 26,082. Notice it's a little bit less because the outstanding balance was a little bit less. And therefore, this difference is now grown. So 30,000 minus 26,082, 3,918. So our entry, I'm not going to do all the entries here. It would have been debit interest expense, 26,082, debit the bond premium for 3918, credit cash for 30,000. So that entry, these numbers feed into the entry. I'm just doing it on a table, but keep in mind, these things are happening back into the accounts. And so now our bonds payable account is 21,647 plus 17,729. That's still 500,000 and 517,729. Now, June 30th, 219. What's 5% of 517? 25,886. What's the difference between 30,000 and 25,586? 4,014. Now I take 17,729. That's sitting out there as a credit. I'm going to debit that for 4,114. I end up with 13,616. Now I'm not doing these in my head, as I wish I could. But I do have the answer in an Excel spreadsheet, which is online for my Canvas student, my students. So you could see these answers and work these on your own. So see how my bond carrying amount is going down, and where's it going to end up? It's going to end up at 500,000, and this is going to end up as zero at the end. I know where we're heading. However you do this. So now, interest expense on 12/31/19, 5% times 513,616, 25,681. 30,000 minus 25,681 is 4,319. So that's a debit to this credit. 13,616 drops down to 9,297. Notice the bonds payable account never changes. And I'm at 509,297. Again, same thing. Really easy when you start. If you work it a few times, you'll have this down. 5% times 509,297, 25,645. And the difference between 30,000, 25,465, 4,535. This is a debit to that credit balance and end up with 4,762. So what's sitting in the bond premium account now is a credit of 4,762. And my bonds payable account's got a $500,000 credit. Add the two credits together, 504,762. All right, last one, 5% times 504,762, 25,238. 30,000 minus the 25,238 is 4,762. In other words, you look at this, I am same entry here, different numbers in cash, debiting interest expense, and this is at 12/31/20, 25/28, and debiting the bond premium. then I had 4762. Look how this works out magically. That's the way. That's because we did value money correctly up front, and we had a 4762 credit balance. We debit that. Now we have zero. Now we have 500,000. By the way, what's the last entry we do? 1231. We're going to debit bond payable. Credit cash. That's the very last entry we did. All right, guys, let's go to the next one, not that one, 14.3. Notice this time, I know right off the bat, we're only paying a coupon rate of 8% and the yield is 10%. So we're gonna have to sell this at a discount this time. So again, I would ask you to pause the video and come back and then watch me work that. All right, number 14.3. Okay, step one. Let's go calculate the price of this bond. So the principal is 500,000. The term, again, 3 years. I had to keep these short, otherwise it'd be pretty boring. And it is 2 times per year, paid semi-annually. And the coupon rate is 10%. Oh, no, coupon rate, sorry, is 8%. And the yield is 10%, or the effective rate, or the market rate. Just keep in mind, the coupon rate determines one thing, the interest payments. The effective rate determines the interest expense. You got to just keep that in mind. I think it hopefully should make common sense, but you know, here, let me pull this over so I can get this in. There, that's much better. Okay, so step one, we've got to go calculate the price of the bond. So we need the present value of 500,000 in 3 years. And so that's going to be N equals 6, 3 times twice a year. We always use the market rate. Don't get confused here. The coupon rate, that's only for the payments amounts. Market rate, that's what we're trying to get to. That's 10% divided by 2 compounding periods. So 5%. All right, you can handle that. So 500,000 future value. N equals 6, I equals 5%. Present value is 373. 108. That sounds really similar to the last problem, which it might be. And then present value of an ordinary annuity, and we've got in this time we've got payments of 8%. So the annuity payment equals 500,000 times the coupon rate, the stated rate. That's how much they're going to pay. That's what they promised, 8%. But I got to divide by that too, so 4%, and that's going to equal to $20,000. Just going to check my math. So N equals 6, I equals 5%. All right, again, easy to do. You can use the tables if you like pain, I guess. 20,000 is the payment. There's no future value. We're trying to calculate the present value. N equals 6, I equals 5%, present value 101 by 114. Market value of the bond equals 373, 108 plus 101 by 114 equals to 474, 622. All right, let's just go ahead and do our first entry because that's going to be required. So 1/1/2018. Debit cash, how much cash we're going to receive? The market value of that, 474, 622. Credit the bond payable. Remember, the bond payable account, the only thing we ever put in there is the face value. And that face value is be what the last day, that's all to be left, and we pay it off, as we saw in the last example. So we've got a problem here. Our debits don't equal our credits. Well, we've got a bond discount for the difference, and that's 500,000 minus 474, 622. $25,378. So kind of want you to keep these entries in perspective, and I will ask for those from my students. But when we do the table, it's basically a way of reflecting those balances and doing the journal entries versus a T account. But so we're going to have in that bond payable account 500,000, and we're going to have a debit 25,378. And so the carrying value is a bonds payable minus a debit, because this is a credit, that's minus a debit. And so the carrying amount could be the amount, at least for this day, the amount we received, 474, 622. So what we got to do, we've got to amortize this down to 0. And this time we're going to be adding to interest expense because think about it, the company only received 474, but they got to pay 500,000 later. So there's another extra 26,000 they got to pay. That's extra interest expense. Why? They're only paid 8% versus the market rate of 10%. So that $26,000 there, that's the 25,000. That's to make up the difference between the 10 and the 8. That gets the investor to the 10%. It gets the company to paying 10%. So we have to affect this correctly in the accounting system. So the payments are always going to be, there's going to be 6 payments, N equals 6 times 20,000. So I'll go ahead and complete my table for those. And then my interest expense, same process for a discount or a premium, just you're starting with a debit versus a credit, but the process for calculating interest expense doesn't change. It's going to be that 10% divided by 2, because we only have 6 months between January and June, 5%. So 5% times 474. 474, 622, 23, 731. But we paid 20,000, so our difference is going to be 3,731. Let's do that journal entry so it helps clarify what's going on here. So on June 30th, we're going to debit interest expense for what we calculated, 23,731. We're going to be crediting cash for how much we pay, 20,000. And see how different this one is than the premium example, because here we need a credit. our debits equal 23,731, but we need a credit. But I'm going to tell you, that makes a lot of sense because we're starting out with a $25,000 debit balance in that account. In the bond discount account, we start with the 25,378, and this has got to go to zero over the 6 years, and so we have to debit it. A debit reduces that credit, 3,731. And so what is now the balance in that account? It's going to be 25,378, what we started the period with as a debit balance, minus the credit of 27,31 to 25,378. $25,378 somehow I'm not getting the same answer. I'm going to check this. All right, let me clear that out. So 25,378, 2,731 minus, I'm getting 22,641, 647. Oh, there's my mistake. I knew. Hey, isn't it great when you have a cheat sheet? Hey, you guys don't get one. I did. 3,731. I just didn't pick up the right number. 3,731. So this should be 21,647. That would have been bad news, and I would not have wanted to start it over. So what's the carrying value now? The carrying value is always the bond payable account balance minus the discount, or the bond payable plus the premium, because they're both credits. In this case, we have a credit and a debit. So 500,000 minus 21,647 equals 478,353. Okay. In the interest of time here, with better handwriting, I just, instead of writing all these out, I'm going to bring these over and show them to you. And so in each case, the interest expense is 5% times the carrying value. So that interest expense of 23,918, that's different than the 20,000. So I'm going to amortize that 21,647 down by 3,918. This is a credit to that debit. Now I have a new debit balance, and I have a new and a lower, a higher carrying value. Note how the carrying value grows to 500,000. That's because this debit balance declines over time, and we end up with 500,000. And in the last entry, obviously, 12/31/20 is debit bond payable for 500,000, credit cash for 500,000. And for you guys who work this, I'll leave this up here for a second so you can you hopefully could pause the video and look at these answers to see how you did versus these answers. I think it'd be pretty boring for me to sit there and go through that every single time. I am going to work some more problems. I think I have maybe one or two more of these, because there is some value in redundancy here. And so I know maybe you'll dial out of the video. If you got it, hey, move on. If you don't got it, keep working these. And and I'm going to stay through the next two problems personally. So hopefully you got that now. You've seen that. Let's go to 14.4. Different numbers. Again, I would recommend that you pause the video and go work this and then come back and I'll work it. Okay, hopefully you're back now. So the principal this time is $1 million. Principal, par value, stated value, you know, all of that. Term is 3 years and paid semi-annually, so 2 times per year on payments. So n is going to equal 6 again. The coupon rate, 3%. That's how much we're going to pay. And the market rate, what the yield, the effective rate is 4%. So investors want to make 4%. We're only paying 3%. So that value of that bond is going to be less than the face value. By the way, if the coupon rate was 4% and the effective rate was 4%, we're paying exactly equal to the market rate. The fair value of that bond would be $1 million. And the price of the bond would be $1 million. And you can do all the time value of money calculations you want at 4%, and you're going to come back to a present value of 4%. But that's only because the payments we're paying at the market rate. We only end up at a discount because we're paying less than the market rate. We end up at a premium. We get more than $1 million if we're paying in the future more than the market rate. That should make sense, hopefully, to you. All right, so let's do the price of the bond. So the present value of $1 million, and N equals 3 times 2 equals 6. I equals 4% divided by 2, 2%. Okay, can handle that. So 1 million is the future value. N equals 6. I equals 2%. Present value 887,971. And then we got an ordinary annuity because payment at the end of payments equals to, and payment comes from here, and that's going to be 1 million times 3%. You know, well, I'll do it now. Divided by 2, or, and that 3% of $1 million will be 30,000. Divide that by 2. The payments are going to be 15,000. N equals 6. I equals 2%. That doesn't change, so I can just do that. Now notice in my calculator, and you have to do that here, I clear every, that's why I'm hitting this clear X key. I clear everything out. Otherwise there'll be some noise in there and I'd get the wrong answer on this. So I've got here 15,000 payment, N equals 6, I equals 2%, and I'm going to go calculate PV, present value, 840. No, 84,000. 84,021. So the value of those payments, $15,000, $15,000 payment, 84,000. The value of $1 million in 3 years is 887. So the value of the bond is this, you know, is the sum of these. So the price of bond equals 887,972 plus 84,021 equals 971,993, and that's less than $1 million. We don't get $1 more, $1 less than the market price, right? Guess what? Our investors, they have time value money calculators too, and they want to get 4%. They're no dummies. And so, you know, they may not think we have integrity if we try to cheat them and say, hey, buy it for $1 million. You know, we're going to give you $15,000. They're smart. They're Wall Street dudes, ladies. A lot of ladies who are very smart. in Wall Street. So let's go do our entry. Maybe the first thing would be good to do that entry. And so 118 debit cash for how much? 971, 993 credit for $1 million. By the way, if you do it this way, like I'm doing it, you'll know it's really clear that it's a debit required, right? And bond discounts are credits, but you got to make your debits and credits equal. I do it that way. I'll never be confused. If my debit of cash is a lot larger than that, I know I got to do a credit there. That would be a bond premium. So that's one way of thinking about it, I guess. So the bond discount is 28,007. There's $1 million and $1 million. And so let's get these into the, let's post these to the table. Bond payable account has $1 million, and the bond discount account is 28,007. What's the carrying value? Bond payable minus a discount, 971, 993. What's our, we'll go do that next one, June 30th. We're going to debit interest expense, and we're going to have to credit that bond discount. We're going to amortize it, and we're going to credit cash. How much do we pay? Well, we've already calculated that. We're going to pay 6 payments of 15,000. What's my interest expense? It's going to be the effective rate is how you calculate. Remember, coupon rate is only for payments, not for the interest expense, not for the discount rate. So 4% divided by 2, 2% times 971 1944 971 993 2% 19,440. So again, step one, take care of your cash. That's what we know. We've already done that over here in the annuity calculation. Step 2, get your interest expense. In the amortization, it's just only the plug to get your debits and credits right, or the difference between the interest expense and the bond discount. So that's going to be 4,440. All right. We know the interest payments are 15,000 every period. And interest expense can be 2% times that, 19,440. And so therefore the amortization is going to be that difference between the 15,000 and 19,440, 4,400 and 440. So I have a debit balance here, 28,007. I'm going to credit that with my bond discount. So that's it's going to come down. It's going to come down to 23,567. By the way, I don't care if you put the parentheses around it. You know, I'll know it's a bond discount if you're doing one of these on the exam. So I'll know bond discount's a debit balance. As long as you're doing the right direction here. 1 million. If you take $1 million, you add 28,000, and that was a bond discount. No, that's wrong. You can't do that. So now the new carrying value, the million minus 23,567, 976, 433. I'll do one more year here, you know, and then I'll show you my own sheet here. So 12/31/18, we'll debit interest expense, the same entry. By the way, no cash, 15,000. Step 1. Step 2, what's my interest expense? It's going to be 2% half of the market rate, because it's compounded twice a year, 2% the market rate, times the outstanding balance at the beginning of this 12/31/18 period, 976. So 976, 433, 2% equals 19,529. And the bond discount now, is this a difference? That's step 3. I got a debit of 19,529. I need a credit of 4,529. So now my credits equal my debits. All right. Come up here and put that interest expense, 19,529. My bond discount, 45,29. And I've got a new balance, 23,567. Debit balance minus this credit, I end up at 19,039. And so still got $1 million in my bonds payable account. That doesn't change. Ended up at 980, 961. Now, here would be a really good question, meaning I like this question. What was interest expense for the first year? Well, guess what? You got to add these two up because this was just for 6 months. So interest expense for the first year would be adding 19,440 plus 19,529. 38,969. And I know I've done that on multiple choice on my exams because I want to at least get you through 2 years on the amortization table. With two payments for the first year. And then I'm not going to complete all this out, but here is the answer to that for those of you who paused the video and kept working this. Now I'll just leave this here for a minute or two so you can look through this. Be really subject to math errors if you had to do this table. So you want to go through it methodically if you're doing this on exam. So again, each of these interest expense numbers becomes, 4% divided by 2 times the ending balance of the prior payment, if you will. And then how much do you amortize the bond by? It's the difference between the interest expense and interest payment. All right, I've got one more of these. It almost seems like too much, but I've got it here. And this one, look at it here. We're paying more than the market rate. So this is another premium example. That would probably be worth, maybe doing. Don't tell me I wasn't working hard on these videos. I'm doing a lot of accounting problems myself here. So again, goal is to help you succeed. I probably won't do all these problems in class. And so people who are confused have the chance to come out here to YouTube and look at these and do more problems. The more problems you do, the better you're going to know it, and you'll be ready for the exam. As I always say, exams like game day, right? And on the football team, they're practicing the same play every day, again and again. So when they come to game day, man, they're ready to go. That's how I want you to be in your game day, which is, whenever you take an exam on this subject. So pause the video and go work this. And then come back. All right. Principal or par value or face value is, like better than that. 600,000. The term is 4 years. That's too bad. I don't even have 4 years on this sheet, but I do on my answer sheet. So I'll at least work through the first payment, first or second payment. Coupon rate, 4%, but the market rates are down, only 2%. Therefore, that's we're paying more. We're going to receive more than 600,000. It's compounded semi-annually, so twice a year. So that's going to be n equal 8. All right. Present value of 600,000. N equals 4 years times twice a year. N equals 8 this time. I equals, we always use this for the discount factor, the market rate, because that's what we're trying to get to in the price. The market rate determines the price of what's the price of the 600,000 cash flow and the payment cash flow. So 2%, 2% divided by 2, 1%. All right. Easy enough. So 600,000 future value, N equal 8, I equal 1%, present value 554,090. Look how close 554,090 is to 600,000. Why is that? Low interest rate. So there's very low interest there, for even though the term is 4 years. So that's a much higher percent. Now we've got an ordinary annuity, so present value of an ordinary annuity, and the payment equals 600,000 times, and we're paying twice a year, so divided by 2, so 600,000 times 2%, 12,000. N equal 8, I equals 2%. Let's go do the math. So we've got 8 payments of $12,000. Discounted back at 1%. Now I would have had the wrong answer on my calculator there. 2% divided by 1, and N equals 8. All right, let's go do that now. Good thing I checked that out. Clear everything out. 6, nope. 12,000 payment. N equal 8. Present value 91,820. Bond value equals, it better be more than 600,000. If you get to where it's more, it's less, then then the coupon rate is higher than the market rate, you got an error, right? So you want to go back and check that. So we got 554,090 plus 91,820 equals to 645,910. Yep, that's exactly right. Entry 1,1,118, debit cash, for how much we're going to receive, the market price, 645,910. Credit a bond premium and credit the bond payable. Bond payable, that's the face value, 600,000. Premium is the difference, 45,910. How about 130,18? We're going to debit interest expense. We're going to debit the bond premium because we've got to amortize that. And we're going to pay cash. How much cash we're going to pay? 12,000. What's the interest expense? Okay, it's going to be the bond carrying value. Let's get these things up there to help us out. That's 600,000 in the bond payable account as a credit, and we've got 45,910 in the bond premium account. Both credits, add them together, and the bond carrying amount is 645,910. That's actually, by the way, what would show up on the balance sheet as a bond payable. That number times 2% divided by 2, 1%. So 645,910 times 1%, I'm going to use my cheat sheet here, equal 6,459. Payments 12,000. The difference there, 12,000. 5,541. So my interest expense, 6,459. My bond premium amortization, 5,541. That reduces my bond premium down to 45,910 minus 5,541, 40,369. Bond payable 600,000. My new carrying value 640,369. Payment of 12,000. 1% times 640. I can do that number. 6,404. Difference in these two, 12,000. 6,404 minus 5,596. And my new balance for my bond premium is 34,773. 600,000. I'm going a little bit fast here, but hopefully you're getting this now. 634,773. See how this is coming down? Where's it going to end up? Going to end up at 600,000. This is going to end up at zero here, right? And of course, this will end up zero when we cut the check, credit cash, debit the bonds payable. If someone asks you, how much was the interest expense in the first year? I think that would be a really fair question on the exam. 6,459 plus 6,404, 12,863. Now, for those of you who completed all 4 years, I'll throw this out to you. And this is the last bond payable. So you even though hopefully people haven't left already, I am going to do an installment note problem here next. And so that'll be the last problem for this lecture. So it might be worthwhile hanging around for that. But I'll let this sit out there for a minute. Hopefully you guys all got that right. All right, let me go work the next one, which is going to be a loan amortization problem. Okay, so now the difference here in the loan amortization problem like this is, you might remember from the last lecture that I did right before these problems, that there's no amount due at the end. There's just going to be payments. In other words, how would this arise? Number one, we might sell something to someone and take an installment loan. So we would have a note receivable, installment note receivable. Now, since we're in a liability chapter, we're going to look at, hey, we bought something and we agreed to pay for it via a note, an installment note. And so the loan amount, here they tell you the loan amount was 200,000. I guess you're going to require us to go calculate the payments, and so then do the journal entries. So that's kind of interesting. We know the loan amount, we know the 4.5% interest rate, we know the term, but we got to go calculate the payments. The only thing that's going to happen here is the payments, and the present value of all those payments that are made is going to equal the loan amount, 200,000. which is going to equal the fair value of whatever we received. We could have done debit cash, credit installment loan. We could have debit equipment, credit and installment loan. And so the very first entry is going to be, yeah, debit cash, credit the loan amount of 200,000. But we're going to have to, you know, then make payments along the way. And part of the payment is going to be interest expense, as we've seen. But part of the payment is going to be bringing the notes payable balance down, because we're going to be paying a lot more than just the interest expense, as we'll see. So let me work. These are not difficult, really. I don't think easier than bonds, because you don't have the discounts and the premiums and the market rate and all that. You only have one rate. So the loan amount is 200,000. The interest rate is 4.5%. Term is 5 years. Payments 2 per year. And the payment amount, we've got to go calculate. Well, that's pretty easy, because let's say we have the things here. Present value equals 200,000. And future value equals 0. At the end, we're not going to owe anything. We don't have another payment at the end. We just have all these payments. N equals 5 times 2 equals 10. And interest rate, because there's 2 payments a year, it's going to be 5.5%, 4.5% divided by 2, or 2.25%. So, and this, if you had one of these problems on the exam, whatever, you're going to have to go calculate the payment. But we know 4 of the 5 variables, and so we can get there. And so I'm going to clear everything out here. Present value is 200,000. Future value is 0. N equals 10. I, and the payment is what I'm calculating is 22,558. Now, there could be some rounding that comes into play here. And so our very first entry, by the way, is going to be debit. Let's say we received cash. You could have received another asset for 200,000 in credit. Note payable for 200,000. So it kind of makes sense there, hopefully, to you. And the payment, 22,558. So we start out, in this case, we use the word principal. It's not quite as formal as in bonds payable. We have all those terms, but I think this is a very common term for the balance outstanding of note payable, 200,000. Now, the payment is going to be the same, like last time. The payments are going to be the same every time. With a lot of these. Okay, and now what is interest expense? Okay, it's 6 months, so it's half of the 4.5%. 2.25% times the principal balance. So I take 200,000 times 2.25%, and I get to 4,500. So think about this in a minute. We paid 22,558, but there's only $4,500 of interest. So that excess amount, this is how all installment notes work. That excess amount reduces the outstanding balance of the principal. And so the difference between how much we paid and the interest expense, 22,558, $18,058 reduced this principal amount. So now the principal is 200,000 minus the portion of this that reduced the principal, 18,058. $181,942. So now the principal is down. What is our journal entry here for this first one? Okay, I'll do the credit the cash. I know that one, 22,558. And then I'm going to debit interest expense that will go to the income statement, 4,500. And I'm going to debit my notes payable by 18,058. So this is the journal entry that reflects what you see here on this chart. And so if we looked at the T account, we'd have a $200,000 credit in notes payable. Now we have a debit of 18,058. The ending balance at June 30th is going to be 81,942. I'm going to walk through this pretty fast, but I take 2% now to 2.25% times 181,942. That's 4,094. That reduced, 18,464. So 22,558 minus the portion that's related to the interest. The remaining reduces my payment towards the principal, and that comes down to 163,479. And in the interest of time and better handwriting, I'll show you the amortization table here. And so this is how, if you have a mortgage, sometimes I can take my mortgage and I'll do 12 months because there's three. Okay, if your mortgage is 30 years times 12 payments a year, so there's 360. N equals 360. Think about that. And I know my rate, and I can calculate down where my mortgage balance is today and where it's going to be 5 years, 10 years from now, and eventually it's going to go, as this one does, down to zero. So in this case, every single time, notice that the interest, this is true with all installment loans, the interest expense is coming down over time. Why? The outstanding balance is coming down. We're paying that thing off. So when you get to the end, you're paying mostly your principal down. You're not having much interest expense towards the end because your balance is coming down. And so this is how a mortgage payment works. This is how a car payment works. Those are installment loans. And so you could do a spreadsheet, do the same logic, and calculate it out yourself. With that, oh my God, that was a lot of work today. So both I did the lecture right before I did this, and now I have worked out all these bonds payable problems. I don't know about you, but my brain is about dead right now. And I've done this a lot of times. I can do it in front of classes a lot too. So hopefully this helps you. I think doing these problems in these amortization tables and these journal entries yourself is the best way to learn. So again, best of luck as you pursue your academic career. Thank you.